Look, I need to tell you something that's going to sound crazy at first, but stick with me because what's happening in the silver market right now is unlike anything we've seen in decades. And if you're thinking about selling your silver, whether it's coins, bars, or even old jewelry, you need to hear this before you make a move you'll regret. 3 days ago, something extraordinary happened that most people completely missed. The silver to gold ratio hit a level that historically has preceded some of the most explosive moves in precious metals history. We're talking about the kind of setup that only comes around once every 10 to 15 years, and here's the thing. Every single time this pattern has emerged in the past 40 years, silver has gone on to outperform gold by margins that seem almost impossible. I'm talking 3 to 1, sometimes 5 to 1 gains. But let me back up and tell you why this matters to you right now, today. You see, most people look at silver and they see this industrial metal that goes up and down with the economy. They think it's just a cheaper version of gold. And that's exactly what the big players want you to think. Because while everyone's been distracted by gold hitting new all-time highs, something has been building in the silver market that's about to catch the entire financial world off guard. Let me paint you a picture of what's really happening behind the scenes. Right now, there are three massive forces converging on the silver market simultaneously. And when I say massive, I mean the kind of fundamental shifts that create generational wealth transfer opportunities. The first force is something that's been quietly building for years, but is now reaching a critical inflection point: the supply deficit. Here's what nobody's talking about. Global silver mine production peaked back in 2016 at about 900 million ounces. Since then, it's been declining. Not by a little bit. We're talking about a steady, relentless decline that has the world's largest silver producers genuinely worried. Last year, primary silver mine production dropped another 4.7%. That might not sound like much, but when you're already in a deficit situation, every percentage point matters enormously. Now, you might be thinking, okay, but can't they just mine more? And that's where this gets really interesting. The average silver mine takes 7 to 10 years to bring online from discovery to production. 7 to 10 years. And here's the kicker. There hasn't been a major new silver discovery of significance in over 8 years. The pipeline is essentially empty, but it gets worse. Or better, depending on which side of this trade you're on. See, about 70% of silver production doesn't come from primary silver mines at all. It comes as a byproduct of mining other metals: copper, lead, zinc, gold. So when copper prices are low or when gold production slows down, silver production automatically decreases. It's not even a choice. The economics just don't work to keep those operations running at full capacity. And right now, we're seeing something unprecedented. Copper mines in Chile and Peru, which account for nearly 40% of global copper production and a huge chunk of byproduct silver, are facing massive operational challenges. Labor strikes, environmental restrictions, aging infrastructure, declining ore grades. The largest copper mine in Chile just announced they're cutting production by 15% over the next 2 years. That's not just copper coming offline. That's millions of ounces of silver that simply won't be produced. But here's where this story takes a turn that should make every silver holder pay very close attention. While supply is contracting, demand is exploding in ways that most analysts completely underestimated. And I'm not talking about investment demand, though that's surging too. I'm talking about industrial demand that's absolutely critical to the modern economy and cannot be substituted: solar panels. Every single solar panel requires about 20 grams of silver. Doesn't sound like much, right? But here's the math that should blow your mind. The solar industry is projected to install over 400 gigawatts of new capacity this year alone. That translates to roughly 150 million ounces of silver, just for solar, in 1 year. That's nearly 20% of total global silver production going into one industry. And solar is just getting started. Governments around the world have committed trillions, with a T, to green energy transitions: the European Union's Green Deal, China's carbon neutrality pledge, the U.S. Inflation Reduction Act. Every single one of these massive initiatives is heavily dependent on solar energy. And every solar panel needs silver. There is no substitute that works as efficiently. They've tried. Copper doesn't conduct electricity as well. Aluminum corrodes. Silver is it. But wait, there's more. And this is where it gets really wild. Electric vehicles. Each EV uses about twice as much silver as a traditional car. We're talking 25 to 50 grams per vehicle, depending on the model. And EV production is ramping up faster than anyone predicted. Last year, global EV sales hit 14 million units. This year, projections are for 18 million. By 2030, we're looking at 40 to 50 million EVs being produced annually. Do the math on that silver requirement. It's staggering. Then there's 5G infrastructure. Every 5G base station requires about 3 times more silver than 4G. And we're not talking about upgrading a few cell towers. We're talking about building out an entirely new network infrastructure across the entire planet. Hundreds of thousands of new base stations, each one loaded with silver, medical devices, electronics, defense systems. The list goes on and on. And here's the critical point. This isn't speculative demand. This isn't people buying silver hoping the price goes up. This is actual physical silver being consumed in manufacturing processes. Once it's used, it's gone. It's not coming back into the market. Now, let me tell you about something that happened last month that sent shockwaves through the precious metals community, even though it barely made the mainstream news. The Shanghai Futures Exchange, one of the largest commodity exchanges in the world, reported that their silver inventories dropped to the lowest level in 5 years. We're talking about a 60% decline in available silver in just 8 months. 60%. And this isn't some small regional exchange. This is China, the world's largest manufacturer, the world's largest solar panel producer, the world's largest EV market. And they're running out of silver. At the same time, the COMEX, the major futures exchange in New York where silver is traded, saw its registered silver inventories fall below 50 million ounces. To put that in perspective, that's less than 2 days of global silver demand. 2 days. Imagine if your local gas station only had enough fuel for 2 days and couldn't get more. What would happen to the price? But here's where this gets absolutely fascinating, and why I'm telling you not to sell your silver right now. There's a group of traders, and I'm talking about some of the smartest money in the world, who have been quietly accumulating massive positions in physical silver over the past 18 months. I'm not talking about paper silver, not ETFs, not futures contracts, physical metal, bars sitting in vaults. One fund manager I know personally, guy who's been in this business for 30 years, managed billions, called the 2008 crash, called the 2020 COVID bottom, told me something 3 weeks ago that I haven't been able to stop thinking about. He said, "In my entire career, I have never seen a setup like this. The risk-reward on silver right now is the most asymmetric I've ever encountered. The downside is maybe 10 to 15%. The upside is potentially 200 to 300%, and it could happen fast." Now, I know what you're thinking. That sounds too good to be true, and normally I'd agree with you. But let me tell you why he's not crazy. Go back to 2010 and 2011. Silver was trading around $18 an ounce in early 2010. By April 2011, it hit $49. That's a 172% gain in about 15 months. And what caused that move? A combination of factors that are eerily similar to what we're seeing today. You had quantitative easing creating inflation fears. You had supply concerns. You had industrial demand picking up. And you had a relatively small amount of capital flowing into the silver market, creating enormous price pressure. But here's the thing. The fundamentals today are actually stronger than they were in 2011. The supply deficit is worse. The industrial demand is higher. The amount of available physical silver is lower. And the monetary conditions are even more extreme. Let me tell you about something called the Silver Institute's annual report. This is the definitive source for silver supply and demand data. Their most recent report showed something that should make every investor sit up and pay attention. For the 4th consecutive year, the silver market is in a physical deficit, meaning more silver is being consumed than is being produced. The deficit last year was 142 million ounces. This year, they're projecting it could be as high as 180 million ounces. Now you might ask, if there's a deficit, where's the silver coming from? Great question. It's coming from above-ground inventories. Stockpiles, reserves, the silver that's been accumulated over decades, and those stockpiles are being drawn down at an alarming rate. Here's an analogy that might help. Imagine you have a bathtub. The faucet represents mine production. That's the silver coming into the market. The drain represents demand. That's the silver being consumed. For years, the faucet was running faster than the drain, so the tub was filling up. Those were the stockpiles being built. But now the drain is wide open and the faucet is barely trickling. The water level in the tub is dropping fast, and once that tub is empty, what happens? The price has to rise to the point where demand is destroyed or new supply is incentivized. And given how critical silver is to modern technology, demand isn't going to be destroyed easily. But let me tell you about another factor that most people are completely missing. And this one involves central banks and monetary policy in a way that's going to sound almost conspiratorial. But I assure you, it's very real. You see, for decades, central banks have been net sellers of silver. They've been reducing their silver holdings, viewing it as a relic of the past. But something changed in the last 2 years. Central banks in several countries, particularly in Asia and the Middle East, have quietly started accumulating silver again. Not in huge quantities that would move the market dramatically, but enough to signal a shift in thinking. Why would central banks suddenly be interested in silver again? Because they understand something that most retail investors don't. Silver is both a monetary metal and an industrial metal. It has intrinsic value from its use in technology, but it also has monetary properties that make it a hedge against currency debasement. And with global debt levels at all-time highs, with central banks printing money at unprecedented rates, with inflation becoming a persistent problem rather than a transitory one, silver represents a unique form of insurance. Now, let me shift gears for just a moment because this is important. If you're sitting on a significant amount of retirement savings, let's say $100,000 or more, and you're concerned about inflation, about currency debasement, about the long-term stability of the financial system, you might want to look into how gold IRAs work. I put together a free guide that explains the process, how you can get physical precious metals into your retirement account without triggering tax penalties, what the rules are, what the costs look like. It's in the description below. No obligation, just information. Worth checking out if that's relevant to your situation. All right, back to why you shouldn't sell your silver right now. Let me tell you a story about what happened in 1979 and 1980. This is one of the most dramatic episodes in silver market history, and there are some eerie parallels to today. In 1979, silver was trading around $6 an ounce. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating massive amounts of physical silver. They believed that inflation was going to destroy the value of paper currency, and that silver was dramatically undervalued. They bought and bought and bought. By January 1980, silver hit $50 an ounce, and 733% gain in about a year. Now, I'm not suggesting we're going to see that kind of move. The market is different today, more regulated, more liquid. But here's what's interesting. The Hunt brothers were eventually forced to liquidate their positions, and silver crashed back down. But if you look at what happened in the years that followed, silver never went back to those pre-1979 levels. Even after the crash, even after the manipulation allegations, even after all the drama, silver maintained a higher baseline price because the fundamental supply-demand dynamics had shifted. And that's what I think we're seeing now. A fundamental shift that's going to permanently reset the price of silver higher. Let me give you some specific numbers that illustrate just how tight this market is becoming. The U.S. Mint reported that Silver Eagle sales in the first quarter of this year were up 47% compared to the same period last year. 47%. That's not a small increase. That's a massive surge in retail demand. And it's not just the U.S. The Royal Canadian Mint, the Perth Mint in Australia, mints all over Europe. They're all reporting the same thing. Unprecedented demand for physical silver coins and bars. But here's where it gets really interesting. The premiums on physical silver, the amount you pay above the spot price to actually get your hands on the metal, have been rising steadily. In some cases, you're paying $4 to $6 over spot for a Silver Eagle. That's a 15 to 20% premium. Why? Because there's a shortage of physical metal available for retail purchase. Now, at the same time, the paper silver market, the futures contracts, the ETFs, is showing a completely different picture. The spot price has been relatively stable, even declining at times. How is that possible? How can there be a shortage of physical metal driving premiums through the roof while the paper price stays flat? This is what's called a disconnect between the physical and paper markets. And historically, when this disconnect gets large enough, something breaks. Either the paper price has to rise to reflect the physical reality, or the paper market loses credibility and people stop trusting it. Either way, the result is the same. The price of physical silver goes up. Let me tell you about a conversation I had with a bullion dealer last week. This guy's been in the business for 25 years. He's seen multiple bull markets and bear markets in precious metals. And he told me something that really stuck with me. He said, "I've never seen anything like this. We have customers calling us every day wanting to buy silver, and we're having trouble sourcing enough inventory to meet demand. Our suppliers are telling us lead times are extending, premiums are rising. And the crazy thing is, the spot price doesn't reflect any of this. It's like there are two different markets operating in parallel. That's the opportunity. That's why you don't sell your silver right now. Because when these two markets converge, and they will converge, they always do, the adjustment is going to be dramatic. Now, let me talk about something that's happening in the derivatives market that should concern anyone who's short silver or thinking about selling. The Commitment of Traders Report. This is a weekly report published by the CFTC that shows the positions of different types of traders in the futures market has been showing something very unusual. The commercial traders, the big banks and institutions that typically hedge their physical positions have been reducing their short positions in silver to levels we haven't seen in years. At the same time, the managed money traders, the hedge funds and speculators, have been relatively neutral, not heavily long or short. What does this mean? It means that the usual selling pressure that keeps a lid on silver prices isn't there right now. The big shorts have covered. They're not fighting the market anymore. And when that happens, when that resistance is removed, prices can move very quickly to the upside. There's a technical term for this in trading. It's called a short squeeze. It's when traders who are betting against an asset are forced to buy to cover their positions, which drives the price higher, which forces more shorts to cover, which drives the price even higher. It's a self-reinforcing cycle that can create explosive moves. And here's the thing about silver. The market is relatively small compared to other commodities. The entire global silver market is worth maybe $50 to $60 billion. That's tiny. For comparison, Apple's market cap is over $3 trillion. One company is worth 50 times the entire silver market. What that means is that it doesn't take a lot of capital flowing into silver to move the price significantly. Let me give you a hypothetical. If just 1% of the money currently sitting in global equity markets decided to move into physical silver, we're talking about over $1 trillion of potential buying pressure hitting a $50 billion market. The price would go absolutely parabolic. Now, I'm not saying that's going to happen, but it illustrates just how sensitive the silver market is to capital flows. And there are signs that capital is starting to flow in. Silver ETFs have seen net inflows for 6 consecutive months. That's institutional money, pension funds, family offices, sophisticated investors who are allocating to silver. They're not buying because they think it's going to go down. Let me tell you about another historical parallel that's worth considering. In 2008, during the financial crisis, silver initially crashed along with everything else. It went from $20 down to $9 in a matter of months. Everyone thought precious metals were dead. But then something interesting happened. As central banks started their quantitative easing programs, as governments started running massive deficits, as people started questioning the stability of the financial system, silver began a rally that took it from $9 in late 2008 to $49 in 2011. That's a 444% gain. Now we're in a similar situation today. We've had massive monetary stimulus. We've had unprecedented government spending. We have inflation that's proving to be more persistent than anyone expected. We have geopolitical tensions rising. We have a banking system that's showing cracks. And we have a silver market that's in a structural deficit with declining inventories. The setup is there. The question is just timing. And here's why I think the timing might be sooner than most people expect. There's a concept in markets called reflexivity. It's the idea that market prices can influence the fundamentals that are supposed to determine those prices. In the case of silver, As the price rises, it attracts more attention, which brings in more buyers, which pushes the price higher, which attracts even more attention. It's a feedback loop. We're starting to see the early signs of this. Google search trends for buy silver are up 180% over the past 6 months. Social media discussions about silver are increasing. YouTube videos about silver are getting more views. Retail investors are waking up to this opportunity. And when retail really starts piling in, when your neighbor and your coworker and your uncle are all talking about silver, that's when things get really interesting. But here's the key difference between now and previous silver rallies. This time, the industrial demand is real and growing. It's not just speculation. It's not just inflation fears. There's actual physical consumption of silver that's increasing every year. That provides a floor under the price. It means that even if there's a speculative bubble that eventually pops, silver isn't going back to $12 or $15. The industrial demand won't allow it. Let me share some numbers from the solar industry that really drive this home. In 2020, the solar industry used about 100 million ounces of silver. This year, it's projected to use 150 million ounces. By 2030, some estimates have it as high as 250 million ounces. That's 150 million ounces of additional annual demand in just one industry over the next few years. Where's that silver going to come from? Mine production isn't increasing. In fact, it's decreasing. The only way to balance that equation is through higher prices that either incentivize new production or destroy demand elsewhere. And here's something that should really make you think. The silver that goes into solar panels is essentially lost. It's not economically recoverable. When a solar panel reaches the end of its life in 25 or 30 years, the amount of silver in it is so small and so dispersed that it costs more to extract than the silver is worth. So that silver is gone from the market forever. The same is true for silver used in electronics, in medical devices, in many industrial applications. It's consumed, not recycled, and that consumption is accelerating. Now let me address something that silver skeptics often bring up. They say, but silver has been in a deficit before and the price didn't explode. Why is this time different? Fair question. And the answer is that previous deficits were relatively small and short-lived. They were met by drawing down inventories, and then supply and demand rebalanced. But this deficit is different. It's larger, it's persistent, and it's accelerating. And the inventories that can be drawn down are getting smaller and smaller. There's also a psychological factor at play. For years, silver has been viewed as gold's poor cousin. It's been ignored by institutional investors, dismissed by financial advisors, overlooked by the mainstream media. But that's changing. Silver is starting to be recognized for what it is, a critical industrial metal with monetary properties that's in a structural supply deficit. When that recognition becomes widespread, when silver starts appearing in institutional portfolios, when financial advisors start recommending it, when CNBC starts talking about it every day, that's when the real move happens. And we're in the early innings of that shift right now. Let me tell you about one more thing that's happening behind the scenes that most people don't know about. There are several large mining companies that have been struggling with declining silver production from their existing mines. The ore grades are getting lower, meaning they have to process more rock to get the same amount of silver. The costs are going up. And at current silver prices, some of these operations are barely profitable. What happens when silver mines become unprofitable? They shut down. Production decreases even further. The deficit gets worse, and the price has to rise to bring those mines back online. It's a cycle that feeds on itself. But here's the kicker. Even if silver prices doubled tomorrow, it would still take years to bring new production online. You can't just flip a switch and start producing more silver. You need to find deposits, get permits, build infrastructure, hire workers, develop the mine. It's a multi-year process. So even if high prices incentivize new production, there's a significant lag time before that production actually hits the market. That lag time is the opportunity. That's the window where prices can run much higher than anyone expects because supply simply cannot respond quickly enough to meet demand. And demand is not slowing down. If anything, it's accelerating. The green energy transition is just getting started. EV adoption is in its early stages. 5G rollout is ongoing. The industrial uses for silver are expanding, not contracting. So, when you put all of this together, declining mine production, structural deficits, rising industrial demand, low inventories, institutional interest starting to build, technical setups that favor higher prices, historical parallels that suggest significant upside potential. The case for holding your silver, for not selling, becomes pretty compelling. Now, I'm not saying silver is going to go straight up from here. Markets don't work that way. There will be volatility. There will be pullbacks. There will be days when you question whether you made the right decision. But if you understand the fundamentals, if you understand the supply-demand dynamics, if you understand the historical context, those pullbacks become buying opportunities, not reasons to panic. The people who made life-changing money in silver in 2011 weren't the ones who tried to time every wiggle in the price. They were the ones who understood the big picture, who accumulated positions early, and who held through the volatility. And I think we're at a similar inflection point right now. So if you're sitting on silver, if you've been thinking about selling because the price hasn't moved much lately, because you need the cash, because you're impatient, I'm telling you, wait. Give this thesis time to play out, because if I'm right, if even half of what I've laid out here comes to pass, you're going to be very glad you held on. The setup is there. The fundamentals are there. The catalysts are there. All that's missing is time. And in markets, patience is often the difference between mediocre returns and extraordinary returns. This is not financial advice. I'm not telling you what to do with your money. But I am telling you to think very carefully before you sell your silver right now. Because opportunities like this, where the fundamentals are this strong, where the setup is this compelling, where the risk-reward is this asymmetric, they don't come around very often. And when they do, the people who recognize them early and have the patience to see them through are the ones who build real wealth.